All right, I want to bring in partner and co-founder of Flynn Zito Capital Management, Doug Flynn. Doug, we need you this morning here. 9 rate hikes in the past year. People are worried about how to manage their money in this, higher interest rate environment in the midst of bank failures. What is your overall advice to people nervous about their money right now?
Well, we all know that we need to keep less than $250,000 in the bank, and I wish more people had the problem that they had to spread their money around to more than one bank. But unfortunately, not as many people as we'd like to have that issue. But the real thing is, if you're in a big, safe bank, you're probably getting some of the lowest yields you can get. And so the first thing you need to do, if you need to keep it all liquid, is you can look to some of those online banks. You just have to make sure they're FDIC insured, of course. And you also want to look to your local credit union. Credit unions typically will pay a little bit more. They're more local, and they're also backed by the NCUA, just like FDIC. It's an insurance that insures up to $250,000. So that's for your liquid money. Those are the things you need to do.
Yeah. What if you're putting money in savings? I mean, talk to me a little bit more about shopping around for the highest interest rate, because for years there just wasn't any yield on cash. There wasn't any yield on savings. For the first time in a long time, people can actually make money with their money.
True. If you have maybe more closer to a year, you could look to some CDs. You can look to some federal or Treasury money market mutual funds, and those are backed by securities that are issued by the government. And those yields now are between 4 to 5%, and some CDs are paying a little more than 5% if you stay on the short term. So that's the first place you need to go. If you have a concern about your money in the bank, you can look to some federal or Treasury money market mutual funds. It keeps it liquid, and the yields are much higher than you're ever going to get in the bank. So it combines. That's a good first place to go. If you have a little bit longer term, we could talk about some bonds and some bond mutual funds.
Talk to me a little bit for people who are trying to save money to buy a home. The real estate market has just been nuts over the past few years, and now it looks like it's cooling a bit, but still, it's like where you live, for example, it's still hard to buy a home. What's your advice for people who are saving to buy a home right now?
So if you have 2 to 3 years, if that's your goal is that far away and you're saving diligently every month, you should look to some bond mutual funds. A lot of people want to get invested in the stock market with that volatility to try to make more money, but you don't need to do that in the near term. It's very likely that if we have a shallow recession, that the Federal Reserve is going to have to shift from its raising rates like it's done the last 9 times to plateauing and then actually lowering rates. And if that happens, you actually can get a positive move with some of your money in those bond funds. So looking in the 2 to 3 year time frame, stay away from the stock market. If usually a house goal is a little bit more near term, if you don't want to keep it totally liquid and get some of the lower rates, you could do that and make a little bit more money. There's a good opportunity there.
All right. There's always opportunity amid chaos. That's what we've learned time and time again. Doug Flynn, nice to see you. Thank you so much.